This presentation is merely a brief overview of the topics covered in the chapter and should not be considered a substitute for reading the chapter. This is a very short chapter, but it covers some important material. In this chapter, we will learn why companies issue stock and bonds and come to better understand financial markets and basic economics. Companies issue stock or bonds to raise capital. By issuing and selling stock, the company raises capital and takes on new investors who own a percentage of the company. By issuing and selling bonds, the company borrows money that they must pay back. Investors with excess capital are always seeking to get the maximum return on their investment possible. Investors typically hope to buy a stock at a low price and sell it at a higher price so that they can make money. They can also make money on stock by receiving dividends, which are financial rewards that companies issue to shareholders. Bonds have a listed interest rate that they will pay and a maturity date when the capital will be repaid. Investors buy bonds and hope to earn a good interest rate on them. This chart shows how investors could have made money two ways on Caterpillar in 2010. Perhaps an investor decides to buy 1,000 shares of Caterpillar at $64 per share in May, spending $64,000 on the stock, plus $10 on the commission. In July, you can see a dividend of 44 cents per share was paid to investors holding CAT. So the investor who bought 1,000 shares received $440 in dividends. One nice thing about dividends received is that they are taxed at a maximum of 15% instead of the individual income tax rate, which would usually be significantly higher. The investor sells all of the shares he owns at $80 per share in October before the October dividend. Also pays a $10 commission to his broker. By selling at $80 per share, he brings in $80,000. You can see from the first calculation, the investor made $16,000 by buying low and selling high. The second calculation adds in the dividends of $440 the investor earned by holding the stock during the dividend period. The last calculation deducts the two $10 commissions, so the investor made $16,420 on Caterpillar in 2010, holding the stock for about half the year. That was an excellent investment. What drove Caterpillar's stock price in 2010? Well, the same thing that drives increases in most stocks: profits, which are also called earnings. Earnings are released every 3 months, so quarterly. The quarterly earnings per share of Caterpillar are listed here. Technically, these are the quarterly earnings per share excluding extraordinary non-recurring earnings. We are interested most in this type of earnings because extraordinary non-recurring earnings are one-time profits that cannot be counted on again. Notice that the company enjoyed excellent growth in earnings and had a very profitable 2010. That made Caterpillar a hot stock with a price that increased dramatically. It isn't enough to just consider an individual company and the possibility that the company will increase profits going forward. Most investors also consider interest rates, inflation, and the monetary policies of the Federal Reserve. Interest rates and inflation typically move in tandem. Higher interest rates discourage borrowing, causing businesses and individuals who were considering loans to decide to wait. This will typically slow the economy a bit because of the lower spending due to less lending. The Federal Reserve can set two target rates: the discount rate, which is the rate at which member banks can borrow money from the Fed, and the federal funds rate, the rate at which banks can borrow from one another. If the Federal Reserve lowers the interest rate, it should stimulate borrowing, which causes more spending and stimulates the economy. If the Federal Reserve raises the interest rate, perhaps to fight inflation, there will likely be less borrowing, which causes less spending and typically causes the economy to slow a bit. Many stocks are heavily influenced by these interest rate, inflation, and Federal Reserve monetary policy moves. Generally, the overall stock market likes low interest rates due to their stimulatory nature, so the market typically gets a little boost when rates are lowered. When rates are raised, the market will react slightly negatively in many cases. That is the end of this presentation. I hope you enjoy reading the chapter.